Between 1977 and 1990, one man turned every $10 invested with him into more than 270,000. Not by trading options, not by timing the market, not by predicting interest rates or reading Fed statements. He did it by walking through shopping malls, eating at fast food chains, and talking to his wife about pantyhose. And if that sounds like a joke, that's exactly the point, because the joke is on Wall Street. Because while every hedge fund manager in New York was building spreadsheets and chasing quarterly earnings whispers, this man was beating almost every single one of them using information that was sitting right in front of you the entire time. His name is Peter Lynch, and depending on who you ask, he's either the greatest mutual fund manager who ever lived or the most underrated one, because most people have never even heard his name. But here's the part that should stop you in your tracks. The fund he ran didn't just beat the market. It beat the market so consistently for so long that professional academics still study it as a statistical anomaly. And yet, and this is the strange part, most of the people who actually invested in his fund during that run lost money. Two facts that shouldn't be able to coexist, sitting right next to each other. So today we're breaking down exactly who Peter Lynch is, how he did what he did, why so many people around him still managed to lose money doing it, and the actual practical framework he used to find these opportunities before anyone else noticed them. Because by the end of this video, you're going to understand not just what Lynch did, but why almost nobody has been able to repeat it since. Let's start with the number, because the number is what earns him the right to be in this conversation at all. In 1977, Peter Lynch took over a small, unglamorous mutual fund at Fidelity called Magellan. At the time, it held about $18 million in assets. That's not a typo. 18 million, a rounding error by today's standards. Over the next 13 years, Lynch grew that fund to over $14 billion, and along the way, he posted an average annual return of roughly 29%. To put that in perspective, the S&P 500 over that same stretch returned somewhere around 14 to 15% a year. So Lynch didn't just beat the market, he roughly doubled it every single year for 13 years straight. And when you compound a number like that over 13 years, the math stops looking real. A dollar invested with Lynch in 1977 turned into roughly $27 by 1990. Try explaining that to someone using normal words and it sounds made up. But it's documented, it's audited, and it's one of the most studied track records in the history of finance. But here's where the story gets uncomfortable, because you'd assume that if you handed your money to a guy compounding at 29% a year, you'd walk away rich. And Fidelity actually studied this. They looked at the average investor in the Magellan Fund during Lynch's tenure, the actual people who put money in and pulled money out, and what they found should terrify anyone who thinks picking a great fund manager is the hard part. The average investor in Magellan lost money, while the fund itself was up nearly 30% a year. How does that even happen? It happens because the fund had incredible years and rough years. In 1980 alone, it returned around 70%. And when a fund does that, money floods in from people chasing the return they just saw in a headline. Then the next year underperforms, and those same people panic and pull out, locking in a loss right before the recovery happens. Lynch himself pointed this out for years. The stock or the fund isn't what loses people money, their own behavior is. And that single insight is arguably more valuable than any stock pick he ever made, because it's the reason most people who read his books still don't beat the market, even when the blueprint is sitting right in front of them. So who is this guy, and how did someone with no Ivy League pedigree end up running the best performing mutual fund on the planet? Peter Lynch was born in 1944 in Newton, Massachusetts, and his early life wasn't glamorous. His father passed away when Lynch was just 10 years old, and his mother had to go to work to support the family. To help out, young Lynch got a job caddying at a local golf club. And it turns out a golf course is one of the best classrooms in the world if you're paying attention, because the men he was caddying for were CEOs, executives, and investors, and Lynch spent those afternoons listening, not talking, listening. He picked up on how these men thought about companies, about markets, about risk. And one of the men he caddied for happened to be the president of Fidelity Investments, which is how, at just 25 years old, Lynch landed a research analyst job at the firm, initially covering unglamorous sectors like textiles and metals. 8 years later, in 1977, he was handed the keys to Magellan. And what he did next wrote what people thought a mutual fund manager was supposed to look like, because most fund managers at the time built their picks around macroeconomic forecasts. Where's inflation going? What's the Fed going to do? What's GDP going to look like next quarter? Lynch thought that entire approach was mostly a waste of time, because nobody, no matter how smart, can consistently predict those things. Instead, Lynch's approach was almost embarrassingly simple on the surface. Invest in what you know. Not literally just companies you like, but companies whose business you can actually explain in 1 or 2 sentences. Companies where you can walk into a store, see the length of the checkout line, talk to your kids about what brand they're obsessed with, and turn that into a real research investment thesis before Wall Street analysts ever noticed the trend. He famously found some of his best investments this way. His wife came home talking about a new brand of pantyhose she loved from a company called Hanes, and Lynch investigated the business behind it. He and his family loved Dunkin' Donuts long before it became a household staple across the country, and he built a position in the stock years before it became an obvious pick. He noticed his kids and their friends were obsessed with Taco Bell, looked into the underlying business, and it became one of the biggest winners in the fund's history. This wasn't a gimmick. It was a genuine edge, because Lynch believed individual investors have an advantage professional analysts don't. You see trends in your own life, in your own neighborhood, in your own shopping habits, months or years before that information ever makes it onto a Wall Street research report. But invest in what you know is the part everyone remembers and almost nobody actually applies correctly, because Lynch was very clear that liking a product is only step 1. The real work happens after that, and this is where his framework gets genuinely useful. Lynch broke every company he looked at into one of 6 categories because he believed the category a stock falls in determines how you should value it, how much risk it carries, and what kind of return you should even expect from it in the first place. The first category is slow growers. These are large, mature, often boring companies. Think utility companies or established industrial giants. They're not going to make you rich, but they're stable. They usually pay dividends, and Lynch generally avoided loading up on them because the upside is capped. The second category is stalwarts. These are big, well-known companies still growing at a moderate, steady pace. Think of a company like Coca-Cola in that era. Lynch liked these as a defensive anchor in a portfolio, something that could still double in a few years without keeping you up at night. The third category is fast growers, and this is where Lynch spent most of his energy, because this is where the massive winners live. These are smaller, aggressive companies growing revenue at 20 to 25% a year or more. The risk is higher, plenty of them flame out. But this is the category where a stock can become what Lynch famously called a 10-bagger, a stock that goes up 10 times over from where you bought it. Lynch didn't need every pick to be a 10-bagger. He needed a handful of them in a portfolio of hundreds, because the math of a 10-bagger is so powerful it can carry the returns of dozens of mediocre or losing picks around it. The fourth category is cyclicals. Companies like airlines, auto manufacturers, or steel producers whose fortunes rise and fall with the broader economy. Lynch's warning here was blunt. Timing matters enormously with cyclicals, and buying them at the wrong point in the cycle, when everyone assumes the good times will last forever, is one of the fastest ways to lose money in the market. The fifth category is turnarounds. Companies that have been beaten down, sometimes left for dead, but have a real, identifiable path back to health. These are higher risk, but Lynch loved hunting in this category because a successful turnaround can produce enormous returns precisely because everyone else has already given up on the stock and the price reflects the pessimism. And the sixth category is asset plays. Companies sitting on something valuable that the market hasn't priced in yet. Real estate, cash reserves, a subsidiary worth more than the entire company's stock price suggests. Lynch loved these because you're essentially buying a dollar's worth of assets for 50 or 60 cents. If you can find them before anyone else does. Now here's the part that separates Lynch from every influencer today repeating, buy what you know, as if that's the whole strategy. Once Lynch identified which category a company fell into, he still ran it through a rigorous checklist before ever buying a share. He looked closely at the peak-E ratio, but not in isolation. He compared it against the company's growth rate using what's now called the PEG ratio, price to earnings relative to growth, a concept Lynch is widely credited with popularizing. A low PE ratio on a company barely growing isn't a bargain. It's a warning sign. But a slightly higher PE ratio on a company growing rapidly can still be an incredible deal. He looked at the balance sheet, specifically how much debt a company was carrying. Because a great business idea buried under a mountain of debt can still go bankrupt in a downturn. He looked at whether insiders, the actual executives running the company, were buying shares with their own money, because that's one of the strongest signals of genuine confidence you can find. And he was deeply suspicious of hot industries and hot stocks that were already the talk of every dinner party and every magazine cover. Because by the time a stock is famous, most of the easy money has usually already been made by someone else. So let's take one of his actual case studies and walk through it, because this is where the framework stops being theory. La Quinta Motor Inns was a mid-sized hotel chain that most Wall Street analysts largely ignored because hotels weren't considered an exciting sector. But Lynch dug into the actual numbers behind the business, the occupancy rates, the cost structure, the expansion plans, and recognized the company was quietly compounding value while trading at a price that didn't reflect any of it. It became one of his standout long-term winners precisely because it was boring enough that nobody else was paying attention. Dunkin' Donuts is another example that shows the full framework in action. Not just the observation that people love the coffee, but the deeper research into unit economics, franchise expansion, and margins that turned a simple personal observation into a genuinely researched fast grower. And Taco Bell followed a similar pattern, an underappreciated fast food name that Lynch's own family life pointed him toward, which he then backed up with real financial analysis before building a serious position. This is the piece that gets lost in every Peter Lynch summary video that's just 3 bullet points long. The observation gets you interested. The research is what actually makes you money. Lynch himself was blunt about this balance. Doing the homework is what separates an investor from someone simply gambling on a hunch. That's the entire philosophy compressed into one sentence. And it's the part almost every retail investor skips. Because doing your own homework is slower and less exciting than just buying the ticker your favorite influencer mentioned yesterday. So why does any of this still matter today, decades after Lynch retired from managing money in 1990? Because the fundamental problem he identified about human behavior hasn't gone anywhere. If anything, it's gotten worse. We now get real-time price alerts pushed to our phones, an entire ecosystem of finance content built around chasing whatever stock is trending in the last 24 hours. And the same emotional trap that hurt Magellan's own investors in 1980 and 1981 is playing out every single day in meme stocks, in options trading forums, in people buying the top of a rally out of fear of missing out and selling the bottom of a crash out of pure panic. Lynch's core message was never really about picking the next 10 bagger. It was about temperament. He believed the biggest risk in your portfolio usually isn't the market. It's you and the decisions you make when the market moves in a direction you didn't expect. He was famous for saying the part of your anatomy that matters most for investing isn't your brain, it's your stomach. Meaning your ability to sit still through volatility without panicking is worth more than any amount of analytical skill. And that brings us back to the paradox we opened with. A fund that returned nearly 30% a year, run by a man who told you exactly what he was buying and why in 2 best-selling books. And the average person who invested alongside him still lost money. Not because the strategy failed, because the discipline did. So if you actually want to apply any of this, the takeaway isn't to go find the next Dunkin' Donuts in your neighborhood tomorrow morning. It's to build the habit Lynch actually built his entire career on. Patient observation followed by real research, followed by the discipline to hold on when the position gets uncomfortable, and the discipline to walk away when a stock has become the thing everyone at the dinner party is already talking about. That's a real 10-bagger, not the stock, the behavior. And in the next video, we're going to break down the specific checklist Lynch used to screen every single stock before it made it into the Magellan portfolio, line by line, so you can actually build your own version of it. So if you don't want to miss that, you know what to do.